Good afternoon, and welcome to this Colony Group Sustainable Investing webinar. I'm Marshall Rowe, President of Business Owner Services at the Colony Group and Managing Director of our Northern New England office. We're joined today by Brian Presti, Director of Portfolio Strategy at the Colony Group, who heads our Sustainable Investment Strategy team. Brian is an industry leader on sustainable investing and is also a chartered SRI counselor. He's led the development, going back a number of years, of the Colony Sustainable Investment offering. Before we begin today, let me review how the webinar will work. Everyone is muted, so you don't have to worry about your dog barking. And only Brian's and my image will be visible, along with the slides. So no worries about privacy. And finally, we encourage you to send your questions. At the bottom of your screen, there is a Q&A box. And if you will submit your questions along the way as you think of them, following Brian's remarks, we will address them and hopefully answer all of them through the course of the webinar. We hope that today's webinar will deepen your understanding of sustainable investing, and specifically that companies highly rated for sustainability will more likely perform well in our changing world, and that those sustainable corporate practices are being recognized by investors, and those companies are being rewarded with higher valuations. In other words, these practices are increasing the economic value of these companies. Brian will also touch on our own sustainable strategies at the Colony Group. Our solutions are designed to meet the needs of clients who want all of their investment assets invested based on sustainable strategies, as well as those who want only a portion or who are just beginning to invest some of their capital in sustainable strategies. We customize each portfolio to align their individual values and capital according to their family's priorities. So Brian, the COVID-19 pandemic represents both a real test and a tremendous opportunity for companies to step up and have an impact on all of their stakeholders. Let's talk about what sustainable investing means in today's terms and why these practices are generating good investment results.
Sure. Thank you, Marshall, and thank you to all who are participating today. I hope that you, your families, and your friends are all staying safe and healthy. Sustainable investing, I'm very passionate about sustainable investing, and we are very excited to share with you our thoughts, insights, and observations about its progress, especially as it relates to some of the challenging issues that we're facing today, namely the COVID-19 pandemic. Many of the central beliefs of sustainable investing are increasingly being reflected in investor and corporate behavior. But first, I want to take a step back and talk about what the goals of sustainable investing are. What are we trying to help clients achieve when they want to integrate sustainable principles into their portfolio? And we really think of three primary goals. Number one is to help you align your investments with your values. Number two, to help you direct capital towards having a positive social and/or environmental impact. And number three, to help you earn long-term competitive financial returns. So thus, we like to think of sustainable investing as offering three returns: a financial return, a societal return, and a values return. And we'll talk a little bit more specifically about how we go about doing that later on. So the key difference between traditional investing and sustainable investing is that the former really solely focuses on the financial return. But what the change that is taking place is that investors are increasingly realizing, and corporations, that you can't think of the financial return and the societal return as separate anymore. And by integrating these objectives, you actually end up enhancing both. So let's talk a little bit more specifically about this kind of secular shift that we're seeing. The Business Roundtable is an association of CEOs at many of America's largest companies. Collectively, they represent about 15 million employees and over $7 trillion in revenues. They promote economic and public policy initiatives. They serve as a think tank to promote a sound economy and respond to economic challenges. Each year, they update their guidelines of corporate governance to provide guidance for public companies and instill best practices. And occasionally, they issue a statement on the purpose of a corporation. So on this slide, you see two statements from the Roundtable, one from 1997 and one from last year, 2019. So for the first time in 22 years, the Roundtable changed the statement, redefining the purpose and role of a corporation. We really feel that these two statements encapsulate the fundamental shift that's been occurring, which is namely the transition from a shareholder-centric paradigm to a stakeholder-centric model. Represented graphically, on the left side is sort of the old model, the shareholder primacy model, where corporate decisions are made solely with the interests, or primarily with the interests of the shareholder in mind. And on the right side is the new sustainable stakeholder-centric model, where corporate decisions should be made, which advocates a new corporate responsibility, that of considering the interests of all stakeholders. So a corporation should create value for not only its shareholders, but its employees, its suppliers, its communities, and its customers. So a corporation can create value for its customers through transparency, service, honesty, and preferences. It can create value for its employees through benefits, a diverse workplace, engagement, and safety. It can create value for its suppliers through fair and ethical practices. And it can create value for its communities through charity, community involvement, and a low environmental footprint. Now, obviously, quite intuitively, there's a clear societal return to a more inclusive, stakeholder-centric economy. But what more investors are realizing is that there are true long-term financial benefits for shareholders as well. And we're going to make some more specific connections to these financial benefits when we look at some examples shortly. And those companies who aren't acting responsibly towards their stakeholders are essentially not valuing the role they play in their success, are really not effectively managing risks that will ultimately affect their financial performance. So thus, a model that on the surface seems to de-emphasize the importance of the shareholder actually ends up rewarding them. So what's good for society is also good for shareholders. And this connects back to the previous slide. The financial and societal return are not loosely connected, but inextricably linked. And this is exactly what sustainable investing, has maintained all along.
Brian, can you talk about specific company practices during the pandemic and how they're responding to the crisis and how those responses are impacting their employees, suppliers, customers, and their communities?
Sure. Yeah, COVID-19 really presents kind of a great opportunity to learn about companies. We can learn a lot about a company's governance from how it responds in a time of crisis. We can learn a lot about management adaptability and resiliency. But really importantly, the crisis provides a real-time opportunity to evaluate a company's responses to its stakeholders. Companies that take a long-term view should most quickly return to high levels of profitability, enhance their brand value, and instill investor confidence. And these benefits really should accrue to the bottom line through higher productivity and other things like that, and should ultimately improve valuations. So let's take a closer look at how companies in the aggregate are responding to COVID-19. So this graph is produced by Just Capital. And Just Capital is an independent data-driven platform that seeks to measure and improve corporate stakeholder performance. They've created a tool that tracks and updates 100 large company responses to COVID-19 in a variety of critical areas. So on the x-axis, you see the array of company responses. And on the y-axis, you see the percentage of companies disclosing these different responses. And on the website, you can actually drill down and analyze how individual companies are responding to their stakeholders. It's not surprising that those companies who have historically followed a sustainable, stakeholder-centric model and demonstrated positive environmental, social, and governance practices are responding extremely well. So next, let's take a look at two companies and how they specifically have responded. We refer to them as corporate first responders since they address the needs of key stakeholder groups early on. These two companies that we'll talk about have been widely recognized as leaders in terms of their ESG practices. So the first example is how Microsoft responded to its employees. And to ease the burden of school closures this past spring, and the fact that many people had suddenly become full-time parents as well as full-time employees, Microsoft provided an additional 3 months of paid parental leave. And they also provided the flexibility to employees regarding when and how they take the leave. Thus, employees were not in a position where they had to choose between their children and their jobs, relieving a great deal of stress. In addition to that, they also continued to pay all their hourly service providers their regular pay independent of whether services were needed. And understand that many of these jobs were perhaps lower paying jobs whose employees were more disproportionately affected by the pandemic. So take a step back and think about the longer term benefits to shareholders because of Microsoft's behavior. Increased employee loyalty, higher levels of engagement, a lower turnover. This should flow right to the bottom line through enhanced productivity and reduced human resources costs. And it's been difficult over the last few years to attract, hire, and retain talent. So the ability to keep talent during the downturn will be a real tailwind during the recovery. And the next example highlights LVMH. And LVMH, based in France, is a global luxury products maker. They have 4,915 stores in over 70 countries. They've been widely recognized as an outstanding company to work for, an exemplary corporate citizen, and a supporter of many social and environmental causes. This example shows how the tremendous response LVMH had, not only toward its immediate community, but toward its global community as well. So they retooled production lines to produce hydroalcoholic gel, otherwise known as hand sanitizer. This gel was distributed free of charge to hospitals, municipalities, police departments, airlines, and supermarkets. At one point, 50 to 60 tons of hand sanitizer were being produced each week. They organized and funded an operation to procure 40 million face masks, which were delivered to government authorities. They purchased 261 respirators, which were delivered to hospitals by the end of April. They delivered 80,000 washable or disposable gowns to hospitals. And lastly, but not finally, actually, they made a financial donation to the Chinese Red Cross and donated medical materials to the Wuhan Anti-Epidemic Center. So again, to take a step back and think of the long-term positive financial implications of LVMH's actions. Stronger relationships with their communities, with their customers, with their governments, enhanced brand value, and stronger goodwill. The quote from LVMH's head of HR that you see really shows how the company is practicing what they preach and living up to their ideals. A sustainable, stakeholder-centric model is not something that they just talk about in their corporate social responsibility report. And there are certainly other examples as well. Another example is how Verizon treated its customers, waiving late fees, overage charges, not terminating service for those who were affected by the pandemic. Think about the long-term benefits to Verizon of increased customer satisfaction and increased retention in what is an increasingly competitive industry in which they operate. And then there's also the example of Gilead Sciences, which donated their entire supply of remdesivir, to the U.S. government. So the key is that investors are paying attention. They're paying attention to how companies responded and are responding during the crisis. Many of the fund managers that we use in our sustainable investing portfolios are also spending a great deal of time evaluating how their portfolio companies and others are behaving during the crisis. In speaking with them and reading their work, they're saying that companies that have historically, scored kind of ranked highly in their ESG practices have responded more quickly and more significantly during the crisis, while those who have scored lower typically are having a harder time responding. And also what's promising is that companies that have been kind of more middle of the road or sort of average are responding just as well as those with historically higher scores or practices, which is really great because it's implying that in the aggregate, more companies are embracing this stakeholder-centric view towards their stakeholders, during the crisis.
Brian, beyond the pandemic that we're facing, there are important social challenges around inequality and systemic racism in our country today. Can you share some perspectives on how the sustainable fund managers, you just mentioned that they were looking at companies carefully regarding their response to the pandemic, but can you share how those fund managers are working with companies to drive change regarding these important social issues?
Sure, yeah, definitely another issue that's obviously come to the forefront, although it's been present, for a while, but really come to the forefront over the last few weeks have been the issues of racial equality and social justice. And while there are several examples of specific company responses that I could share, I thought it would be helpful to convey how sustainable fund managers, have approached these important issues. And the simple answer is that many sustainable fund managers have been looking through this lens for decades, since their inception and through their history. They've been integrating criteria related to racial equality, social justice, and human rights into their investment processes and into how they engage with companies. This is not new to them. And there's really kind of two primary ways in which they do it. The first is they use the criteria as a key input in determining what companies to buy or sell. And then the second way they use it is they'll use the criteria to determine which companies they engage with to affect change. This is called active ownership, and we're going to talk a bit more about it shortly. So this quote here is from Joe Keefe, President and CEO of Pax World Funds, in a recent letter called A Call to Action for the Investment Community. Pax launched the first socially responsible fund in 1971. They've been leaders in engaging with companies to get them to improve their practices, especially in the areas of gender equality, pay equity, and board diversity. They're also a founding member of what's called the 30% Coalition, which is a group that seeks to advance gender diversity on boards. And that coalition last year launched a national campaign to promote women of color on boards. And so this is an example of how PAX has been really focusing on these key priorities of racial equality and social justice, really going back, 50 years. The next example on this slide is taken from Calvert Research and Management's Principles for Responsible Investment. And Calvert has been managing sustainable mutual funds since the early 80s. Their principles form the basis of and a framework for all their investment research and engagement processes. In fact, they launched their first equity fund to specifically express an anti-apartheid in the mid-80s. And they were the first fund to sponsor a shareholder resolution tied to a social issue in 1986. So another example of how of a fund manager prioritizing the ideals of racial equality and social justice really since their inception and throughout their history. And actually just last week, Calvert CEO on their website reinforced their long history of support for racial equality and diversity, and laid out 5 key action steps the company will take to further strengthen and refine that role that anti-racism and social justice has in their investment decision-making and engagement processes.
Ryan, as this slide notes, investors are taking notice, and now roughly 25% of all investment capital is directed using sustainable guidelines. Can you talk about these trends and the fact that the strategies have been performing very well, not only over the last 5 or 10 years, but even during this more recent period of pandemic-induced market volatility?
Sure, yeah. I mean, investors are certainly taking notice. This chart shows quarterly flows into sustainable investing funds over the last 11 years. And you can obviously see a trend that had been gaining momentum, but that really just took off recently. The sustainable fund flows hit a new record in the first quarter of 2020, and this follows a record 2019. And what's especially impressive about the first quarter of 2020 is, as you're probably not surprised by, most equity strategies had outflows, whereas sustainable funds had record inflows. And there are many reasons for this, but I think this really reflects what we've been talking about today. And that's that move toward a more sustainable, kind of long-term stakeholder-centric model of investor and corporate behavior. But I'll also say that I believe it stems really from the belief that sustainable investing is simply good investing. These companies should perform better over time for all the reasons that we've discussed. And the data on the next slide, kind of generally supports this. So, one of the central theses of sustainable investing has been that sustainable companies are less risky because they're effectively managing material ESG risks that other companies aren't. And that they should provide kind of long-term risk mitigation. Their emphasis on higher quality should perform better in a downturn. And so we had the first real litmus test of this in the first quarter. And I would say sustainable funds generally delivered. 44% of sustainable funds, as you can see on the top there, finished in the top quartile of their categories, and 70% finished in the top 50%. And what's also noteworthy is the bottom, which shows the year-by-year trend. So if you take a year like 2019, 65% of sustainable funds finish in the top 50%. So we're generally seeing pretty good performance in both up and down markets. And I think investors are beginning to ask themselves, if I can align my investments with my values, if I can have a positive societal impact, and I can still earn competitive financial returns, then why wouldn't I do this? So we'll end this part of the presentation and talk a bit about the sustainable investing solutions that we offer at the Calvert Group. And again, 3 objectives we're trying to help you realize: values alignment, positive societal impact, and competitive financial returns. And from an investment perspective, we really designed the portfolios to achieve 2 primary goals. The first was to provide broad diversification across asset classes: US equities, developed international equities, emerging market equities, fixed income. But even just as important, we wanted to allow you to have targeted impact on the issues that you are most passionate about. And so we do this by complementing broadly diversified sustainable funds, consisting of companies like the ones we talked about today, with thematic funds that focus on specific social or environmental issues. So if you're passionate about the environment, we can help you tilt your portfolio to have more of an environmental impact. If you're passionate about gender equality and the equitable treatment of women, we can help you tilt your portfolio to have impact in that manner. And this is one of the approaches we use to help clients realize that values alignment, sort of that values return that I talked about on the first slide. We also talked a little bit earlier about active ownership. Active ownership is a very important aspect of our approach. Active ownership is exercising your power as a shareholder to affect change on material ESG issues or to improve corporate performance. You can do this through proxy voting, shareholder resolutions, direct company engagement. Those are the strategies that our funds will typically use. Any sustainable fund manager will tell you there's no such thing as a perfect company. Active ownership helps good companies become even better and helps sort of marginal companies really kind of step up their game. So it's a requirement that any sort of manager that we use exercises active ownership and has demonstrated a long, consistent, and successful track record of doing so. And our managers have engaged with companies on the issue of gender pay equality and board diversity, like we talked about with PACs, but also other issues like gun and ammunition sales and climate change. And we think this is a key differentiator of the Colony Group's offering because not all managers use active ownership, and many of them use it kind of rather inconsistently. I'll also mention too that our sustainable several of the sustainable fund managers we use themselves are responding to COVID-19. PACs, Boston Trust Walden, Community Capital Management, Parnassus signed on in support of an investor statement on COVID-19 responses. This letter's been signed so far by 329 investors, representing about $9 trillion in assets. And in that letter, they urge businesses to prioritize employees and stakeholders as they evaluate their responses to COVID-19 and advocated for policies like paid leave, ensuring health and safety, and worker retention. And then the last thing I'll conclude with is just to reinforce what Marshall talked about at the beginning in his introduction, in that our sustainable investment solutions are very customizable and flexible. This is not an all or nothing choice. We certainly have clients who will dedicate 100% of their portfolio to integrating sustainable objectives. We have others that may just carve out a slice. We have clients that use, one or two themes, some that use more than one or two themes. The point is that we've designed them so that we can help you kind of realize, whatever sustainable objectives you may have. So that kind of concludes my portion, and Marshall, would love if you opened it up to Q&A.
Sure. Thank you, Brian, very much for sharing your thoughts. And we have received a number of questions, which hopefully we can get to all of them. Let me start with the first one. And you mentioned the shift from a shareholder focus to a stakeholder focus, the Business Roundtable definition of purpose of a corporation. And that at the core of this is ESG. It's a term you've used a number of times. Can you provide more detail about what the E, the S, and the G actually mean and represent?
Sure, absolutely. Yep. Very acronym used in the industry. And ESG stands for environmental, social, and governance, and specifically refers to three areas that sustainable investors will evaluate when analyzing a company. Each one of these groups has particular factors or criteria that investors will take a look at. So for instance, E, or environmental factors, may include a company's waste and pollution policies or its energy efficiency. The S factors may include a lot of the things we talked about today: treatment of the workforce, treatment of the supply chain, treatment of labor, health and safety. And then G factors, governance factors, would include things like board diversity, board structure, compensation, and transparency. And the key is that sustainable investors believe that you must evaluate these factors alongside traditional financial metrics, because if you don't, you simply don't have a complete picture of a company, nor can you accurately predict its future financial performance if you don't look at these factors. And that's because these factors are material to companies' bottom lines. And so that word material, the other aspect of ESG is what we call materiality. And that's the belief that there are simply certain factors that are more material to a company's bottom line based on the industry in which they operate. So a bank, environmental practices, while important, are not nearly as important as its governance. A retail company's environmental practices, while important, may not be as material to its bottom line as its supply chain or labor policies. So when we evaluated which managers we wanted to use in our portfolios, we wanted to make sure that they were integrating ESG criteria throughout the whole investment process and that they were paying attention to materiality. So really, I mean, ESG factors are really, I think it was like the building blocks of sustainable investing research.
Great. Brian, we at the Colony Group are very strong believers in diversified portfolios, both within the equity markets and across different asset classes. Can you share how sustainable investing impacts the diversification of a portfolio? And for example, even in the equity space, are there sustainable strategies in the emerging markets or, for example, in the fixed income markets?
Mm-hmm. Yeah. I mean, before I mentioned that, one of our primary goals was to be able to provide kind of globally diversified multi-asset class portfolios in a sustainable manner, just like you could with traditional investing. And the simple answer is that we can absolutely do that because we've got the ability to access sustainable strategies in multiple asset classes. So I'll talk a little bit about emerging markets and fixed income. And emerging markets is actually one area that we think where a sustainable manager can add a lot of value because although they're improving, a lot of emerging market companies have tended to have lower governance scores. And although they're improving, they also tend to have kind of lower environmental scores. So this really opens up an opportunity for a sustainable manager to not only seek out those companies that are operating at a sort of an above average level, but more importantly, to engage with those companies to help them improve their practices. So the sustainable fund that we use in our portfolio for emerging markets is actually sub-advised by a European asset management firm that has a long history of investing in emerging markets in a sustainable manner and with engaging with those companies. On the fixed income side, it's a little different than equities, but a lot of fixed income managers are still looking at the E, the S, and the G, when they're evaluating bonds, for instance. So one of our partners, one of the managers we use in our portfolios, is one of the pioneers of integrating ESG criteria in both municipal and taxable bond research. They've been doing it for about a decade now and are thought of as sort of like the leader in that space. And so they'll look at social characteristics of a particular county or town. They'll look at the environmental issues related to coastal communities and what that may mean for the effect on spreads for certain issuers in those areas as well. And then on the taxable side, one part of our fixed income portfolio has some exposure to impact bonds. So impact bonds are bonds that are issued to have direct purpose, social or environmental purposes. So affordable housing bonds, economic development bonds, natural resource or energy efficiency bonds, sometimes known as green bonds. One of the funds we use will have a good allocation to those types of bonds within its overall portfolio. So we're really finding really great solutions in a lot of different asset classes.
Brian, you've mentioned during the presentation that many of these strategies have performed quite well, both over the long term, but also more recently. And from standing back and looking at that performance, one question that I've gotten is that being substantively driven by the fact that typically those strategies don't invest in the energy or oil industry, and the fact that the oil industry has had a rough go over the last decade? Or are there other factors that are driving the good performance of many of these strategies?
Sure. Yeah, so the Morningstar data that we looked at related to performance, Morningstar, and I've actually seen this from other providers as well, did an attribution analysis of sort of the performance of sustainable funds and what was causing the outperformance. And they found that certainly not having energy or having a low exposure to energy helped, but it wasn't the number one reason. The number one reason was those ESG factors, that helped with the outperformance. So it certainly was a tailwind, to a certain extent, but it wasn't the most important factor. And the other thing the way I would answer that too is the fact that sustainable funds have been either, fossil fuel free or had limited energy exposure is not luck. That was an active choice that sustainable funds have made, just like any other active manager would make. And it was based on the fact that they not only saw sort of the environmental impact aspect of it, but they saw real financial risk, with investing in energy companies, material risks that energy companies may not be fully reflected in energy company valuations. And they've been talking about that for years. And so it happened to have come to fruition and was a benefit, but it was part of their process that led them there.
Do you have an example, Brian, of a company that you can share the perspective about how they may have changed their corporate behavior as a result of active ownership?
Yeah, sure. Yeah. So there are a few examples. One of them I'll talk about, and I'll talk about PAX again. PAX engaged with eBay a few years ago because eBay had a relatively low representation of women in senior leadership positions, and they only had one woman on their 10-member board. And so PAX engaged with eBay to get them to adopt policies that would increase the likelihood that there would be more women in positions of senior leadership and in board representation. And these engagement efforts, they don't happen overnight. They can take, 3 or 4 years because PAX sent them, I think it was a shareholder resolution. eBay kind of ignored it. They went back to them. They just kind of kept at it. And eventually they were successful. And so now eBay has 4 women on their board. They have a very higher representation of women in senior leadership position. But more importantly, they've changed their governance and their policies, which will increase the likelihood that that will continue in the future. So that's one example. Another quick example is Parnassus, who engaged with Mondelez, who is the largest snack foods producer in the world, to get them to commit to recyclable packaging by 2025. And so that's another great issue on more of the E part. So, but I could go on for hours about other really good examples, but that should give you a flavor for what these fund managers are doing.
We had one other, which I'll touch on briefly, but then you may want to add to it. There's a question about income inequality and how that's being handled. And I know from our engagement with these fund managers and their engagement with companies that another example was when they pressured, I'll use the word, Apple into doing a survey of income or pay disparity across the company. And it was through the active engagement of the fund managers that Apple reformed its pay practices. I think this was focused on gender equality specifically.
Yeah. And that's the key. The key is a lot of fund managers will approach companies initially from, we just want to see more disclosure, right? We want to see what types of policies you have in place to so that the fund managers can at least have a starting point upon which to engage. And so in that case, it was a matter of getting Apple to, and it was PAX again, getting Apple to disclose what their pay practices are, and then once those are analyzed, to have a discussion about okay, well, is there some improvement that can be done to lessen, income inequality, whether it's gender or whether it's, racial. So disclosure is a very important part of engagement. So that's extremely important.
Brian, one of the questions focuses on sort of the priorities of environmental, social, or governance. And I know that, at least in my experience working with our clients, generally the focus tends to be on the environment or social strategies. There's a little different perspective about who cares about governance. Can you share a little bit more about that?
Yep, exactly. Yeah. So, if there have been a lot of surveys done about, which of these factors are more important to different investor groups, and individual investors usually feel very strongly about environmental or social issues. When asset managers or fund or investment managers are interviewed, they certainly care about those issues, but it's really governance that they're focused on. Quality of management, transparency, fair compensation structure, no conflicts of interest, because that really can set the tone for the whole company. So not to pick on a particular company, but Boeing was a company that has been mostly avoided, although not totally, from a lot of sustainable funds because of their perceived material risk in their governance practices. And so that was primarily the G. There might have been a little bit of E in there too, but primarily the G, which, the material governance risks that cause a lot of sustainable funds to avoid that. And I would say the same with another bank. I won't mention the bank a few years ago that ran into problems. That was actually at the time owned by some sustainable funds who would then engage with the bank. The bank wouldn't change and they sold their stock. So they divested.
Brian, one of the ways this has been pursued by investors historically is that they might buy the shares of a company that they thought needed to improve its practices, and they would either vote their proxies against the management positions, or they might show up at a shareholder meeting and express themselves. But it appears over time that the significant impact, and it really comes down to that active ownership advantage of these fund companies versus individual investors just voting their proxies. Do the fund managers use proxy voting as a tool as well as the kind of engagement that you're talking about?
Yep. They'll use proxy voting, as a tool as well. I would say, and a lot of the fund managers are really, and this is important, transparent about how they vote proxies. So they'll put everything on their website. This is how we voted on all these issues. And then they'll provide what's called sort of impact reporting and give kind of larger statistics. So one of the fund managers that we use consistently votes 100% for climate change initiatives, or 100% for gender pay equality initiatives, et cetera, et cetera. So it's definitely a tool that's used. I would say that, shareholder resolutions and company engagement have tended to have more transformative types of results over time, especially since, a number of, not all, the fund managers we use tend to be pretty big, and they have a lot of scale and they have a lot of influence. So, when such and such fund company calls such and such company's management, they listen. They're not just some kind of small shareholder. So,
and the next question is around who does the ratings of the companies? Where does this data come from that these fund managers are using? It sounds, as you've described it, that some fund managers do their own research as to the business practices of any given corporation. But are there outside firms that are doing this research, and what's the process of that information flow?
Sure. So there are kind of two main strategies that are used in terms of ranking or scoring companies, and there are a number of third-party ratings providers, namely MSCI and Sustainalytics are the two big ones, but there's some other ones as well. And what they do is they will gather information that typically comes directly from the companies. It's often kind of self-disclosed, but it may also come from non-governmental organizations as well. And then they'll, based on that information, they'll kind of rank, create a score for the company on a bunch of different factors, and then an overall score for the company. And then a fund manager, some fund managers have used the strategy where they will just simply take those ratings and kind of rank the companies and then create a portfolio. The other strategy is to maybe take a look at some of that information and use kind of the raw data, but then use your own proprietary process, that maybe you've used for 20, 30, 40 years, and integrate that data into a process that combines both quantitative and qualitative aspects to it. So, while I very much applaud what the third-party rating agencies are doing, because they're increasing information, they're increasing disclosure for people, information for people to evaluate, we found in our research there were some challenges to just using that data. Some of it was missing, some of the important material factors may have been missing. A lot of it's self-disclosed from companies, so there might be a bias there. It tended to reward companies who disclose more, so unfairly punishing smaller companies, who may not have the infrastructure to report more information. So we felt we wanted to partner with managers that had their own proprietary processes where they could kind of fill in the gaps. They could reach out to the company and kind of fill in these gaps, and not rely completely on kind of 100% quantitative data, because the qualitative aspect is very important as well.
That's great. And shifting gears a little bit, if a client or an investor wants to embrace sustainable strategies, they've never used them before, how do you or how do we learn about what their preferences are and use that information to develop a portfolio strategy for them?
Sure. Yeah. So we incorporate it, when we're sitting down with a new or even an existing client, we incorporate it, into just how we would ask questions about their tax situation or their, liquidity needs or other sort of questions, typical questions. We do ask about their kind of sustainable objectives. And the way we do that is we use a questionnaire. We use a questionnaire at the Concord office that helps us to kind of pinpoint exactly what the client's particular objectives are. So which issues do you feel passionate about? How do you feel about having energy exposure in the portfolio? Because there are clients who don't want to have any energy exposure. And what percentage of your portfolio do you want to dedicate to a sustainable strategy, so that we can kind of have a guidepost that we're looking to get to over the long period of time. So we look at it as kind of essential information, just like we would with any other aspect of their financial picture. And then once we have that information, it gives us an idea of how we would create a portfolio. Because there are clients who maybe they don't want to express any themes. Well, that will influence how we create the portfolio. There's many clients who want to express 2 or 3 different themes. And so we'll incorporate that into the portfolio. And then the next and last part is the actual implementation and the portfolio, moving from traditional investments to sustainable investments. And for some clients, taxes can be an issue because they may have embedded capital gains in the traditional investments. So with a lot of clients, we will take a kind of a multi-year approach where, let's say a client wants to have 50% of their portfolio invested. It doesn't make sense to do that all in one tax year. We'll take 2 or 3 tax years to do it. But to the extent we can, we'll try to do it in a tax-deferred environment so that we can kind of get more accomplished early on.
Great. And you've mentioned, and the word impact has been used several times. And obviously all of these different types of corporate engagement are meant to have an impact on the practices of these businesses. But there's another, that term is also used to describe sort of a type of investment, an impact investment. Mm-hmm. Can you share an example of what an impact investment might be, or sort of that category of investment?
Sure. Yeah. So, an impact investment is it tends to have a more specific social or environmental goal alongside a financial return. And we think, and you've touched on one of them, that there are 3 ways that you can have impact in our sustainable investing strategy. And one of them is certainly active ownership, because there you're seeing real impact. A company is at point A and they get engaged with and they go to point B. So you see that positive impact. The second is one I've mentioned a little earlier, which are impact bonds. So bonds that are issued to have a specific impact on things like affordable housing, economic development. We have the ability to allocate there in our fixed income portfolio. And then the third is the thematic funds, because thematic funds are more concentrated funds that are targeting impact in very specific areas: the environment, water, women's leadership, etc. So those 3 areas we think are kind of good examples of impact investments. But there are also impact investments in the private markets. So, for those investors who qualify for private strategies, there are, lots of different opportunities in the private markets to have impact. And those are strategies that we are going to be developing over time, at the Colony Group.
Great. Thank you, Brian, and for sharing your knowledge and expertise today. You're truly an industry leader, and you've developed a great sustainable investing platform and capability for the Colony Group that allows advisors and their clients to customize their strategies. And I, for one, really appreciate that you've been able to identify fund strategies that have achieved very positive long-term rates of return, and that are also aligned with the priorities of our clients and their families around environmental, social, and governance issues. I want to thank all of you for joining us today, and would like to invite you to reach out to your Colony advisor if you have any additional interest, or if you would like to consider embracing sustainable investing. The questionnaire that Brian referenced, we'd be happy to send it to you and share any additional information. You will find that there is additional information on the Colony website, but each of these strategies are customized to each family, and your advisor would be happy to work with you to develop the themes or the approach that would be most rewarding to you and your family. So thank you for joining us this afternoon. We appreciate your interest in the Colony Group and our sustainable strategies, and we wish you a good afternoon. Please stay safe and well.
Goodbye. Thank you.